Welcome back to Wake Up with Cheddar. Futures a bit higher this morning. NASDAQ futures getting a boost from strong earnings results from Amazon and Alphabet. They came out after the close yesterday. The Reddit-led trading mania seems to be calming slightly. Treasury Secretary Janet Yellen will be holding a meeting with officials from the SEC and the Federal Reserve to discuss the market volatility caused by Reddit-favored stocks this week. And taking a look at the markets, the Dow actually has turned a bit lower this morning after the major indexes closed sharply higher Tuesday. Investors also looking ahead to private payroll numbers. They come out at 8:15 a.m. Eastern time today. It is estimated that about 49,000 jobs were created in the private sector for the month of January. For more on the markets, I want to bring in Thomas Hayes, chairman of Great Hill Capital. Thomas, great to have you on with us this morning. A lot of volatility on Wall Street last week, and now a two-day rally to start this new month. So what's behind the optimism?
Well, thanks for having me, Jill. What you're seeing here is the Reddit rebellion is starting to unwind. They have a famous saying on their message board called Diamond Hands that refers to don't sell GameStop. And it looks like yesterday there were a few cubic zirconia hands in the mix because they were selling everything that wasn't nailed down to get off margin. The short squeeze is done. The short interest is down to 36%. And they're selling just like hedge funds had to sell their winners last week in order to pay for their losers. So you saw Apple was down despite strong earnings to pay for GameStop. And what we've seen in the last 2 days is now that that unwind is done, hedge funds are now re-risking quickly because earnings are coming in much better than expected, and stimulus is on the way, either through cooperation or through reconciliation. That's coming. And on a daily basis, Jill, we're seeing vaccinations go up and cases come down. So that's very positive.
But we did see, in terms of that Reddit mania, we did see how relatively easy it was for a group of retail investors or whoever was behind that rally to really move markets, right? And to send a stock like GameStop, where the fundamentals just simply did not support the valuation that it wound up trading at. And we saw a bunch of hedge funds lose a ton of money. So you think that's really over, or do you think that these retail investors or these Reddit investors could just set their sights on something else? You know, if hedge funds continue to do these shorts or investors continue to short markets, they might see more opportunity down the line.
Yeah, well, I think what you're going to see is the new retail participation is not going away. The GameStop was a unique situation with 140% of the float short, and I don't think hedge funds will make that same mistake twice. That was foolish from a risk management standpoint. That's one of the first things you would look at if you're going short. And they basically saw an opportunity collectively and through communication to squeeze them, and they won. They absolutely won. You know, the saying, bulls make money, bears make money, pigs get slaughtered. A lot of people made money on the trade, and the ones that are holding on too long might be a little piggy here, and they should take the money off the table and book the win for sure. So looking forward, Jill, the CBO put out their projections for this year. They're expecting economic growth to hit a brand new high by mid-year. They're expecting unemployment rates to plummet to 5.3%. And they're expecting inflation to remain subdued, and that's even without the new stimulus. So hedge funds really have to re-risk here. And our general view has been ignore the noise. You know, the S&P 500 is up about 75% off the March lows. That's a big run. We may be due for some consolidation, but we're just stepping back and looking at where is there still value? What hasn't run that's due to run, that's reasonably valued, that can do really well over the next 12 to 18 months. And one of the sectors we still love here, you know, the last time we were on, we were talking about, you know, banks and energy. Well, they've had a monster run in the last 4 months, so now they're resting. But we like defense and aerospace on a commercial aviation recovery in the second half of the year. And that can be played through an ETF like ITA. There's a few different ETFs, or you can pick the heaviest weights. We like Raytheon. There's also Boeing, Northrop Grumman, Lockheed Martin, et cetera. So that's really where we're looking for value in a market where there may be some pockets of froth. You're seeing IPOs go out with valuations of 30 plus times sales. Obviously, you're seeing the SPAC, the just tremendous amount of SPACs, tremendous amount of retail call buying and retail participation. So I think we're due for basically some sideways consolidation, digest the gains before looking up and finishing up the year strongly in the second half.
Any advice for the retail investors out there who perhaps just got involved with the market during this pandemic and maybe only think the market goes up? Any advice for people?
Well, I'll say the best thing that I ever did when I started in the business, I read a book by Ben Graham. It's Warren Buffett's favorite book, called The Intelligent Investor. And it really walks you through how to discern value in the market. And it goes through the concept that in the short term, the market is a voting machine. We saw that with GameStop, completely detached from fundamentals. But in the long term, it's a weighing machine. And eventually, these companies do revert back to their intrinsic value over time. And just having that primer, it's a few hundred pages. It's Warren Buffett's favorite book. It's really going to give you a grounding. So when you see these things happen, you can choose to proactively participate and ride it, knowing that it's detached from fundamentals, or you can say, I'm going to wait and I'm going to buy things that are values presently, like we're talking about the defense and aerospace sector, and be patient for the next 12 to 18 months and see measurable, consistent gains versus trying to get rich too quickly. That usually doesn't end well.
A good old-fashioned book. Can you turn it into an Instagram story or a TikTok video? Anyway, Thomas Hayes, chairman of Great Hill Capital. Really good advice. Thank you so much for coming on this morning. Appreciate it. When we come back, McDonald's doubling down on its plant-based meat offerings. There's more Wake Up with Cheddar right after the break.